Understanding real estate investment tax implications. Key tax considerations for real estate investors. Income tax on rental earnings. The IRS taxes rental income as ordinary income, which includes rent payments and any fees or additional charges paid by tenants. However, investors can deduct a wide range of expenses, such as mortgage interest, property taxes, insurance premiums, property management fees, maintenance, and improvements, along with depreciation. This comprehensive approach to deductions can significantly reduce the taxable income derived from rental properties, highlighting the importance of detailed record-keeping to maximize tax benefits. Capital gains tax on property sales. When a real estate investment is sold for more than its purchase price, the profit is subject to capital gains tax. The rate applied depends on the investment holding period. Profits from properties held for less than a year are taxed at the investor's ordinary income tax rate, while those from properties held for more than a year benefit from reduced long-term capital gains tax rates. Strategic selling, based on holding periods, can result in substantial tax savings, emphasizing the need for long-term investment planning. Passive activity losses. The tax code restricts the deduction of losses from passive activities, such as most rental real estate activities, against non-passive income, like wages. However, there are exceptions, especially for real estate professionals and investors actively participating in their rental activities, allowing them to offset passive losses against active income. Understanding these rules can unlock potential tax deductions, but navigating them requires careful attention to IRS guidelines and potentially the advice of a tax professional. Leveraging depreciation. Basics of depreciation. Depreciation allows real estate investors to deduct the cost of purchasing and improving a property over its useful life, as defined by the IRS. This deduction acknowledges the property's wear and tear, deterioration, or obsolescence. For residential rental properties, the IRS sets the useful life at 27.5 years, meaning the purchase price of the property, excluding land, which is not depreciable, can be deducted in equal parts over 27.5 years, providing an annual tax deduction that reduces taxable income. Residential versus commercial property. The IRS differentiates the useful life of residential rental properties, 27.5 years, from that of commercial properties, 39 years, affecting the annual depreciation deduction. This distinction necessitates that investors carefully categorize their properties and apply the correct depreciation schedules, impacting the yearly tax benefits they can expect from their investments. Cost segregation studies. A cost segregation study is a tax strategy that accelerates depreciation deductions by identifying personal property assets within a real estate investment that can be depreciated over a shorter period, typically 5, 7, or 15 years, rather than over the longer 27.5 or 39-year periods. This front-loading of depreciation expenses can significantly increase tax deductions in the early years of property ownership, improving cash flow and reducing tax liability. Conducted by professionals, these studies require a detailed analysis of the purchase price, including allocations for items like non-structural elements, land improvements, and indirect construction costs. Tax benefits of ownership structures. LLCs and S corporations. Choosing the right ownership structure, such as a limited liability company, LLC, or an S corporation, can have significant tax implications for real estate investors. LLCs are popular for their flexibility, offering the benefits of pass-through taxation, avoiding the double taxation associated with C corporations, and limited liability protection, which shields personal assets from business debts and liabilities. S corporations also provide pass-through taxation and can offer savings on self-employment taxes compared to sole proprietorships or partnerships. However, each structure has specific operational and tax reporting requirements, underscoring the importance of consulting with a tax professional to determine the most beneficial setup for your real estate investments. Real estate investment trusts, REITs. REITs offer investors a way to invest in real estate without directly owning properties, providing regular income streams and significant tax benefits. REITs are required to distribute at least 90% of their taxable income to shareholders as dividends, which are then taxed at the shareholders' individual income tax rates. This distribution requirement allows REITs to avoid paying corporate income tax, making them a tax-efficient investment vehicle for those looking to gain exposure to real estate markets. However, investors should be aware of the tax treatment of REIT dividends, which can be more complex than those from other investments. Partnerships and joint ventures. Partnerships and joint ventures allow multiple investors to pool resources for real estate ventures, offering flexibility in allocating income, gains, losses, and deductions among the partners according to the partnership agreement. This flexibility can be advantageous for tax planning, allowing investors to structure deals in a way that optimizes tax outcomes for all involved. However, these arrangements also require clear agreements and meticulous accounting to ensure that all tax liabilities and benefits are appropriately allocated and reported. Advanced tax strategies for real estate investors. 1031 exchanges. Deferring capital gains tax. The 1031 exchange, named after Section 1031 of the IRS Code, enables investors to defer capital gains taxes by reinvesting the proceeds from the sale of an investment property into another, like-kind property. This powerful tool can help investors reallocate their investment portfolios without incurring immediate tax liabilities, facilitating portfolio growth and diversification. However, strict rules govern these exchanges, including the types of properties that qualify and the timeframes for identifying and purchasing replacement properties. Requirements and timelines. For a 1031 exchange to be valid, the investor must identify potential replacement properties within 45 days of selling the relinquished property and complete the purchase of the replacement property within 180 days. Failure to adhere to these timelines can result in a taxable event, negating the benefits of the exchange. Additionally, the entire transaction must be facilitated by a qualified intermediary who holds the proceeds from the sale until they are used to acquire the replacement property, ensuring the investor does not take constructive receipt of the funds. Reverse and improvement exchanges. Reverse exchanges, where the replacement property is purchased before selling the current property, and improvement exchanges, which allow investors to use exchange funds to improve the replacement property, offer additional flexibility. However, these types of exchanges are subject to their own set of complex rules and require careful planning and professional guidance to execute successfully. Opportunity Zone investments. Tax incentives. The Opportunity Zone program, created by the Tax Cuts and Jobs Act of 2017, encourages long-term investments in economically distressed communities through significant tax incentives. Investors can defer taxes on capital gains invested in qualified opportunity funds, QOFs, until December 31, 2026, reduce the amount of gains taxed through a step-up in basis if the investment is held for 5 or 7 years, and potentially eliminate taxes on gains accrued from the Opportunity Zone investment if held for at least 10 years. Requirements. To qualify for these tax benefits, investments must be made through a QOF, and the funds must be used to acquire and substantially improve property within an opportunity zone or to invest in qualified businesses operating in the zone. The rules require that the QOF substantially improve the property, typically requiring the investor to invest an amount equal to the purchase price of the property, excluding land, in improvements within 30 months of acquisition. Long-term benefits. The Opportunity Zone program's most significant tax benefits are reserved for investors willing to commit capital for at least 10 years. This long-term investment horizon allows for the potential appreciation of the investment free from capital gains tax, offering a compelling incentive for investors to contribute to the revitalization of underserved communities while seeking tax-efficient returns on their capital. Tax-efficient financing and withdrawal strategies. Mortgage interest deduction. For real estate investors, the mortgage interest deduction represents a significant opportunity to reduce taxable income. Interest paid on mortgages for investment properties can be fully deducted from rental income, lowering the overall tax liability and improving cash flow from the investment. This deduction applies to loans used to purchase, build, or improve rental properties, making it a crucial consideration in financing decisions. Cash-out refinance. A cash-out refinance involves replacing an existing mortgage with a new loan for a higher amount than the current outstanding balance and then receiving the difference in cash. This strategy can provide investors with liquidity without selling the property, and importantly, the cash received from a refinance is not considered taxable income. This can be particularly advantageous for investors looking to reinvest in their portfolios or cover expenses without incurring additional tax liabilities. Real estate professional status. For individuals who qualify as real estate professionals under IRS rules, the ability to deduct rental property losses against other income can be significantly beneficial. To qualify, individuals must spend more than half of their working hours and at least 750 hours per year materially participating in real estate as developers, brokers, landlords, or similar roles. Achieving this status allows investors to bypass the passive activity loss rules, enabling the full deduction of all rental losses against other income, which can be particularly valuable for those with high levels of real estate activity. Conclusion: maximizing your real estate investment returns. Through careful planning and strategic decision-making, real estate investors can leverage various tax laws and financial strategies to significantly enhance the efficiency and profitability of their investment portfolios. From understanding the foundational aspects of real estate taxation to implementing advanced strategies like 1031 exchanges and investing in opportunity zones, the opportunities for tax optimization are vast. As we wrap up this episode on real estate and tax efficiency, leveraging property investment, remember that the journey to maximizing your real estate investment returns is ongoing and multifaceted. Staying informed, seeking professional advice, and continually adapting your strategies to the evolving tax landscape are key to achieving long-term success in real estate investing. For those seeking personalized guidance on real estate investment and tax efficiency, or how to manage your real estate portfolio using QuickBooks, Professor Sam and I are here to help. Reach out to us at george@baueradvice.com or visit baueraccounting.com for expert consulting services tailored to your unique needs. Thank you for joining us on Tax Management Mastery. If you found this episode insightful, please subscribe to our channel for more strategies and tips on navigating the complexities of taxes and investments. Until next time, I'm Professor George, wishing you prosperous and tax-efficient investing.